Hello and welcome to Fireside with the VC. My name is Andrew Romans, and today we're going to take a deep dive on SPACs. So SPACs have been going crazy. For those that have been following the numbers, SPACs have been around for a long time, and we've got an expert who can tell us more about that. But to give a sense of how fast this has been blowing up and growing, we were getting around 9 to 20 SPAC deals per year from 2011 to 2016. And then 9 to 20 turned into 30 to 60 through 2019. And then in 2020, this just blew up. In 2020, I think we had 248 SPACs, 248 up from what was just 30 to 60. That was 2020. And then while a lot of people are, sitting in sweatpants, cashing in a unemployment check, we had 296 SPACs from January of 2021 until March 21st. So the deal volume, the amount of capital going into these went from about $1 billion per year to 100 billion. So I think everybody in the VC entrepreneur game wants to understand what these are, what they mean for us. Are they suitable for our companies, for your company, and how it's changing and evolving? So I'm really excited to have Adam Birnbaum from Gp Bullhound, who's an expert on this topic, who can walk us through it. I've been friends with the founders of Gp Bullhound since before they founded it, watched these guys build an amazing bank and be able to attract Wall Street guys like Adam. So Adam, welcome to the podcast.
Hey, thanks very much, Andrew. Pleasure to be here.
So Adam, why don't you start us off, and we'll get into how it's changing, but for those that don't understand yet, I want to understand, what is a SPAC? What does it even stand for, the acronym? And we'll dive into what the moving parts are.
Sure. So a SPAC is the acronym is a Special Purpose Acquisition Corp. And it's also been termed as a blank check company. It's actually a concept that's been around for a while. It was actually invented, I think, 1993 or 1994. It's in the early 90s, invented by an attorney who actually was looking at a structure where people could put together a blind pool of capital and then go out and find a company that they could merge into. I would tell you that because of its beginnings, it was really designed for much smaller companies. And for many people, quote unquote, what they would do is they would view that as a backdoor way of going public. Right. I think over time, what's occurred is, it's gone through ups and downs, and it's gotten some bad reputations back, 15 years ago, and that sort of went away. And now I think people see it as a vehicle that is a way to enhance another alternative for companies to access the equity markets in the U.S.
I mean, you've had search funds have been around for forever, where
Sure.
Someone has a fund, they hire some young guys, some older guys, some younger lady, older lady to run around with some walking money and then acquire a company for whatever size, but those aren't going public. And then we've had reverse shell mergers going on for the IPO market, quite common on the ASX in Australia or even AIM. So we've kind of seen something like this before, but it's just picked up really big. I mean, we could talk about why it's happening, a bit later, but walk us through what are the actual moving parts? Like when a SPAC happens, what are the different phases that you go through to ultimately get to this publicly traded, and who are the main actors in it?
Sure. So I think we should start by saying the SPACs that we talk about now it's actually a public offering. It's actually an initial public offering, but it's an initial public offering of capital that's being raised. So the first party is the sponsor in the SPAC. The sponsor is somebody who is actually footing the cost and footing the risk to see that they're going to be able to attract an underwriter and a manager to do a transaction. They're going to have to go through the legal cost of filing a document with the SEC. They're going to have to put the organization together to go out and find the company. And then they're going to have to go out and speak to investors and do that. So it's actually, this is the sponsor of the SPAC. Okay. That's the first participant. Second participant is, you have the investor. So the investor is the people who go out and invest in the SPAC initially. And you might, a little bit different than an IPO, the people and the individuals who invest in an IPO of a SPAC aren't always the same people who are participating in the SPAC afterwards. There's a change in the shareholders, and we can get into that a little bit later.
And also, Adam, even I've, with my own network, I've had a bunch of people ask me to invest into their SPAC while they're putting together their sponsorship. So people have asked me to put money in to give them the ability to do what you just said, file the S1 and all that stuff. So some people are kind of buying into the sponsor, even.
Exactly. And this has been one of the evolutions, and we can get into this a little bit later, Andrew. But what's happened is that as opposed to it being a one-off kind of, I do a SPAC and that's it, there are people who become expert in this, do this extremely well, and people follow them. So when they're going out and raising another SPAC, because of their network, because of their agility and being able to consummate transactions, because of their network of companies they can find, they will immediately get a group of investors together. And there are a few names that you hear a lot. Chamath from Social Capital has really been a pioneer in this. Michael Klein and Churchill Capital. There's numerous others. There are people who actually sold companies into SPACs and then have ended up becoming sponsors of SPACs after the fact. Mr. Branson would be an example of that, Richard Branson. But just finishing off the lineup card, so to speak, to use a baseball term. In terms of who are the other participants? So we talked about the IPO investors. I would tell you that there are individuals who will invest in the IPO of a SPAC. There are hedge funds who invest in the SPAC. You're seeing a change now where you're actually seeing some, what I would consider more longer term, investors that you would consider, the brand names of institutional investing, Fidelity types of the world, Neuberger Bermans, who may even invest in the SPAC initially or invest as part of the IPO deal. The third key participant is the target company. The reason for a SPAC is to go out and find a company and acquire them. So this is the company that's sitting there and saying, what should I become part of a public company? Ergo, should I become a public company as a result of this transaction? So that's another participant who's out there.
And don't you have so you've got the sponsor, either they've got enough money on their own. Richard Branson's not short of cash, but some are, or someone to de-risk it and bring me in or somebody. Then you've got the IPO investors, and isn't there the PIPE investor? Isn't there?
Yes, I was going to get to that. If you were to ask me what's the biggest dynamic that's changed in the SPAC market over the last few years, certainly in the most recent past, I would say it's the introduction of PIPE investors. PIPEs are not a new phenomenon either. Private institutionally placed equity is not a new occurrence. What is a reasonably new occurrence is the fact that they participate in SPAC transactions. And what they do is they're basically very, very large, they don't always have to be, but a lot of times they're very, very large institutional investors, the names of which, I had mentioned before. They come in, they spend time with management. They're a lot of times, and most times, they're over the wall in terms of confidential information. So they're prohibited from some of the trading activities, and this is all done from a compliance standpoint. And they understand the ins and outs of the transaction. So the question should be, why would they do this? What's the benefit to them of doing this? The benefit is that if it's a unique company and it's a unique opportunity, it really gives them an insight into the business, but more importantly, it gives them the opportunity to attain a significant stake in a company, which if they were to do this in the regular markets, they'd be driving their own price up, as an example. So it's an opportunity to really, really dig into a business, demonstrate it. Now, it's not so much that it's become this, but what this has evolved into is that they're almost the third party arbiter of the judgment of the deal and the valuation. So the rest of the institutional market looks at this and says, again, not to promote or utilize it in term too much, but a company like Neuberger Berman, they're in, T. Rowe is in, and they're in at this valuation. This is probably an interesting business, to participate in. And so what happens is you will frequently see that the announcement of the transaction in conjunction with with the announcement of the deal and the PIPE investor will happen simultaneously. And then you see some of this, you know, a very, very euphoric activity in stock prices that happen.
So to compare it to in an IPO, you've got like VCs like GP Bullhound and 7BC fund this company. It gets to the point that, you know, typically some big JP Morgan, Goldman Sachs is ready to say, you meet the test of what we expect the market to bear. So they're gatekeepers. And then they take a company where we know everything about that company. You file the S1 and then you do a roadshow where you're hitting Fidelity and Mass Mutual and all these big institutions. And then, you know, inside people with Goldman managing your 50 million, they get into the IPO, but they know what the target is. They know what the company is that is going public, and then it starts trading to the public. Here, you've got sponsor, then you do the IPO investors who still may not know what the company is that's to be acquired, and then they've got 24 months to find a company to buy, and then take public, like almost reverse shell merge into that listed vehicle.
Exactly.
And so they buy a company that's instantly publicly traded. But when do the PIPE investors come in? You were saying that that's simultaneous. How is the PIPE investor different than the IPO investor?
Okay, so the IPO investor, so you raise a very good point. The first question is, why would somebody do this? I don't even know where they're going. You know, why would somebody invest in a SPAC? Somebody's going to come out and say, I'm going to raise $250 million, and guess what? I'm not even going to tell you who I'm buying. The reality is they tell you generally where they're buying, because they're usually, what's usually happening, and the reason why people invest is because you're assembling a team of experts who've done successful deals in a segment. They have a network of groups of parties that they're out in contact with. So when they do the IPO, you raise an outstanding point, Andrew, and I missed this in terms of saying this. In the US market, you know, when somebody invests in a SPAC with the SPAC has 24 months to do a deal.
Okay.
They also have to do a deal. They can't do a roll-up. It has to be 80% of the amount of money raised. You know, you're not going to give somebody a pool of capital and say, oh, let me buy this a great little company. I'm going to buy this one. I'm going to merge it with this one, merge it with that one. No, it has to demonstrate 80% of the value of the company. Second thing is, and this is one of the evolutions that occurred, is that, you know, while you're waiting for the company to find the transaction, you're earning interest. You know, so there's actually a legitimate interest rate hedge that can go on. So there's not, you know, you really have real upside. The investor, the IPO investor, to get into a little bit more detail, which is very important, frankly, is the IPO investor is getting a share, plus they're getting a warrant in the company. Now, when the sponsor starts the company, they're getting warrants also. The sponsor, the promote, so to speak, and I'm talking US SPACs where the lion's share of the market, well over 90% of the market has been invested in US registered securities for the SPAC market. But what they're getting is they get a share, and it usually represents about 20% initially of the amount raised. So that's the reason. That's a critical element. Why else would somebody go through this risk to do this? And they do it, not to get into too much, you know, esoteric stuff, but they do it in the form of a placement of warrants. That's how they get proceeds.
And just for our listeners listening to this, warrants are like stock options, but not for the employees, right? So it's the same thing as
it's the right to buy a share. Right.
So it's an option to buy equity, typically at a fixed strike price.
And it's always at a higher stock price, right? So interestingly, all SPACs are done at about $10, but the strike price on all the warrants is generally around $11.50.
Okay, $11.50. So that's not a huge amount on, you know, the kind of bump we've been seeing. So the warrants are quite valuable if you look at historically what kind of bump you're getting from $10, you know, up, with a few exceptions. Okay. And with a typical process would be sponsor, you know, manages to say, I'm here, I'm doing this. They go through the raise IPO investment. How much money are they raising on this roadshow typically?
The amounts have been increasing. You would have seen probably 10 years ago, deals would have been done at $50-60 million. Now what you're seeing is transactions are being, the average size is probably in the $350 million range.
So
And you're seeing
350.
larger and larger deals done. That's the amount of capital that's being raised to do a transaction.
Okay, so sponsor gets IPO investors to pull together 350 million, and then they've got to buy a company that's going to eat up at least 80% of that.
Correct.
And if they don't, they got to return the money after 24 months.
Well, mechanically, what really happens is the shareholders in the SPAC have the right to agree or not agree with the deal. They can vote against the deal.
Oh, really?
And get their and if they don't like the deal, they get their shares redeemed.
Okay.
It's actually a little bit of a nuance. You can really get into a lot of tactical efforts. You can technically agree to the deal, which is odd. You can vote in favor of the deal and still redeem your shares. That's a technicality. Somebody might say, why would you do that? Maybe they want to hold on to the warrants. Maybe there's some trading activity. Stock has already gone up because a PIPE investor has been involved. But that's
That sounds like it shouldn't be allowed. If what percentage, like in venture capital, you need 75% limited partner consent if you want to go past 12 years or something. What kind of voting governance is there on
it varies. I mean, usually the sponsor is going to vote in favor of the deal. I mean, it's usually like a majority of the shares, and could be a super majority. I mean, and that's why there's this whole the original IPO investors. They're called, like, there's the different colloquial terms people talk about, people who invest in SPACs, institutions who invest in SPAC IPOs, versus the people who invest after a deal is announced and then they're merging into a new target company. And I mean, the companies that do this have become reasonably high profile companies. DraftKings, Hostess was an old one from years ago. We just saw, WeWork, which was considered, a company that was on the ultimate demise, has been put into a SPAC by the founder of TIPCO software, So I mean, you're seeing, Galactica Space, Richard Branson's company, the electric vehicle companies, Nicole, the different versions of Tesla, So I mean, you're seeing that. You asked the question before, which I apologize, I didn't get to. You're saying where are you seeing the SPACs? The large share of them are technology oriented companies.
Okay.
Really, I would say what we would define, which is where Gp Bullhound lives, as you know, I would say probably 40% of the companies have some sort of TMT element. And then there are other technology oriented, other angles, whether it's EV or otherwise, which you can certainly put in that bucket as well, which would increase it. So you really do see a high preponderance of technology oriented companies. But I mean, it is interesting, I mean, the structure, that ability to agree or not agree with the deal and get your shares back or get interest while you're waiting.
You get warrants. It seems crazy.
I mean, another thing that's really interesting is most of the deals have been done in the US, but in Europe, they have negative interest rates. So you actually, the sponsors a lot of times in European deals, and there's been a small smattering of it, it's not been a ton of them. But in the European deals, the sponsor actually has to put money in to compensate them for the negative interest rate that you have while the money is being held.
So I wanted to ask you what interest rates are. So like on a convertible note in Silicon Valley or London or anywhere, you kind of have a standard 6%, or it's 4%, or if they're not trying to make it too attractive, but they're trying to keep it legal, it's like a 2%. And then, redemption or dividends in the old days was 8%. So when a VC puts 5 million in, it's like a backdoor way of lifting the liquidation preference. But, if this founder takes forever, getting the 8% almost feels fair to me. If I invest 5 million and it's Instagram, Insta billion, hey, that was a quick hit. Forget interest rates or dividends. But what's a typical interest rate on a SPAC?
This is very, very modest. I mean, this is like the risk-free. This is really risk-free rate, because it's basically like the money is sitting in escrow. Think of it the same way you would invest funds in an escrow account. I mean, it's literally what it is. It is an escrow account because it's cash that's being held there. So nobody is participating to try to take a ride, because actually the person who's at risk there, or the group that's at risk, is the sponsor. The sponsor has a requirement to deliver that money back, so they're not looking to arbitrage or take any risk there. It's basically rock solid guaranteed money, because to the extent the money is not in the trust, that becomes a whole kind of governance, would be looked at very poorly. Nobody does that. So
And
it's really,
if sponsor successfully completes with IPO investors, let's just say $300 million raised,
yeah.
but then identifies a target that's bigger than 300 million, is that where the pipe investors come in?
Yes, and in fact, you raise a really interesting point, Andrew. It's not only do they need to get 80%, but remember how I was telling you that there's a 20% promote? So the evolution of the market has become that even though 300, let's use that number for argument's sake, 300 is raised, the enterprise value of the companies they're acquiring tend to be at least 3 to 5 times that.
Right, because otherwise the sponsor taking 20% of the,
Exactly.
because with an IPO, all that waterfall preferred Series A, B, C, different classes of shares theoretically goes to one class of shares, right?
Correct. And the same thing goes on. I mean, when this, it's also an interesting point. When you're all said and done with the SPAC, with what's called the SPACing process, when you're talking to institutional investors after the IPO, after the company's announced, after the PIPE and everything else, at the end of the day, this is a public company. I mean, people are not, people aren't, 4 years from now, or, and now, like, again, using it like DraftKings, I mean, 2 years from now, people aren't going to be saying, oh yeah, it was a SPAC, I mean, they want a clean capital structure. It's a trading company, just like any other trading company. And, it's going to have research coverage. It's going to have traders. It's going to have, all the things that make for a liquid public company, so, I mean, this is the way they go public, but then, they're public on their own. So it's a different thing.
So if you had 300 million raised from the IPO process, they announce and identify we're buying DraftKings or something people know about, and then they raise another 700, so they get like $1 billion of cash has come into this. The sponsor owns 20% of the whole thing.
No, no. He gets a fixed number of shares. You raise,
20% of the first 300.
I mean, let's say if you have, just using round numbers, you look at the pro forma shares outstanding of the capital raise. It's always $10 a share, right?
Right.
So if you raise if you raise 250 million, you got 25 million shares outstanding. On a pro forma basis, when you take the promote shares, that's 6125 or something. So you take 6125 over 3125. That's the 25 million plus the promote shares. It represents 20%, but that's a fixed number. And I would also tell you that certainly doesn't go up over time. And as part of the negotiation, I don't want to use the term sausage making, but the way deals are cut between the PIPE investors, sometimes, the sponsor will cut back a little bit on the shares, just to make the economics look good for the PIPE investor, make the economics look good for the public investors who are going to be valuing the company afterwards, and making the company look good for the target, so they look attractive. And then you might say, well, why would they do that? Well, look at the numbers. If you put in, let's say, $6 or $7 million, assuming you're able to hold your whole 20%, your share, your number of shares you have, you would be like 10x that right out of the box. That's before the stock goes up in value. So you have an enticement, if you want to or need to be a little bit flexible.
Sure.
And I think there's a very important point here as it relates to shareholder profile, Andrew. The biggest portion of shares usually is retained by the target, right? So the PIPE puts in money that you get, $100 million, $200 million. You have the money that you have originally from the SPAC IPO, but then in terms to get to this larger enterprise value, the people who are doing the deal, the target, their existing shareholders say, oh, I'll retain, I'm going to hold on to, just same way in an IPO, you don't sell the entire share offering, there's a float. And the existing target holds on to a decent amount of the shares. It could be 50%, 60%, 70%.
Okay, because in a classic IPO, you sell 20% and then they oversubscribe it, and there's a green shoe, so it's like a little bit more than 20%. Here, you're seeing that the existing investors of the target company, I guess the
Are-
de-SPAC company, they might be as low as 50% of this whole thing, or
Yeah, I mean, I think you're seeing a lot more, you see, it will vary. Of course, why would it vary? You may have a private equity firm in that wants to monetize, some of their position. People look at a lot of this then and say, hey, why are they selling so much? So, there's a little bit of an aesthetic that's going on as well. But, sometimes you have different investors. They've been in the company for a while and so on. But I mean, the way you get the enterprise values up, so how did they go from 3x to 5x, to, not, whatever, 9x? Yeah, it's because the target company is retaining a significant portion of the shares, which if you're a new investor, you want to see that, right?
yeah, it's a good way to stabilize the post-listing performance. What
It's
about lockup?
demonstrating that you believe, right? That this is, you're a believer in the company.
Sure. And let's talk about lockups, and then eventually I kind of want to compare this versus IPO, SPAC versus
Sure.
IPO. But what are, I remember I lived through the dot-com days where I had a company that I founded that got to a $1.2 billion valuation, and then the dot-com thing melted down, and there's a lot of people that were worth a fortune in 1999 and 2000, and then by 2002, not so much. And so people's idea of like, I remember Morgan Stanley was the lead underwriter of my company, and they said 18-month lockup for me. 18 months when I was the first one at this company. These guys just showed up and they're going to go straight out to the Hamptons and buying property and boats after like 1 minute of being with the company. I'm like, how is it that you're liquid on all your warrants and I'm supposed to sit around for 18 months to signal to the market that you get out before me? So I kind of had a little bit of an experience with that. But what are lockups right now for a vanilla IPO when JP Morgan is your lead underwriter? And then what's the lockup looking
You
like
know,
for different actors in the SPAC world?
I mean, I think like in the SPAC world, you'll see, a lot of times this, a typical structure in the US, and it'll vary, you'll see a 6 month lockup, you'll be released from a 6 month lockup if the stock trades at a certain price, let's call it a 25% increase over 20 out of 30 days consistently, then it's 150 days from the day of it, so I mean, of the combination. So I mean,
Is that for the shareholders of the target, or
this is for the sponsor company, so it could be a year, and then it's you could be released from it for 6 months. The target, it's going to vary as well. I mean, 144 stock is a year lockup. 144 shares are a year lockup. The one thing, I mean, at a different point in my career years back when I was, doing a lot of IPO work and so on, the reality is, as there's a lockup, but you could always be released from the lockup by the underwriters. And like part of you could say, it's like, oh, that's interesting. They've got you over a barrel, but what they're also doing, not to, sort of, wave a flag for investment bankers, but they're also trying to make sure that would not create a lot of popularity. But, I mean, the reality is they're trying to create an orderly market. And I mean, in some respects, it's for everybody's good, right? If you say to people, hey, you can do whatever you want, you're going to have insanity out there. I mean, and this gets back to my prior point about why PIPE investors are interested in investing the time, because it's a way for them to attain, a number of shares in an orderly fashion. They want to be, otherwise you get all kinds of crazy trading activity.
You're competing with yourself. Yeah. So I think they want to make sure that $10 a share goes to 20, 30, and it doesn't go to 7. If they all go to 7, then the PIPE people go away. The whole thing,
it's bad. Yeah, it's a disaster. I mean, and a lot of this, a lot of the increase in size is being driven because, again, it is an IPO. It's a public company, so you want liquidity. You want liquidity in the shares. You want a liquid trading market, and that's why you're seeing some of the smaller, SPACs. They're still being done. They're being done by smaller firms, but you're still seeing them, but they're to some extent less interesting because they don't have the same level of liquidity. So
yeah. We've seen that historically, like in AIM, there was a time on the alternative investment market of London, which that's like the baby exchange of the London Stock Exchange,
Sure.
that there was a time when you could get a nomad and some brokers, list your company, and if the market cap was below 100 million sterling, there was essentially zero liquidity. That was the expectation. If it's above 100, you actually are a true, proper listed IPO'd company with the ability to sell according to lockups and using common sense. But people were doing it because it was an alternative to meeting 100 VCs, going through the valuation and everything, and all the things that come with that, liquidation preferences and stacks. Where here, you're one class of shares. You've now done a fundraising exercise. So people were doing it for the actual fundraising. So even though there's no liquidity, people did that with eyes open, saying, this was the right thing to do for me because I raised the money without all this, pain of dealing with VCs who were not giving me the valuation I wanted and, all those dividends and everything else. But, and what about, let's talk about a little bit about size and then even some of the M&A activity that's being driven to position things for being SPACed. And before I forget, like people say de-SPACed. So when they say de-SPACed, just define what that means so that I don't look stupid at a dinner party.
No, absolutely. It sounds very nefarious, right? The de-SPAC, but I mean, what it really is it's the I would call it disintermediation, but it's really the transition of shareholders. There's a type of shareholder who does the IPO with the sponsor. There's a shareholder base that's going to be your long-term holders, and there are also going to be ones who are voting in favor of the deal. And sometimes you want to there's different dynamics. Everybody's got a constituency. So the investors, the hedge funds who invest in a SPAC, they have a constituency. They want to play off the interest rate. They want to they may participate in the deal. They may hold on to the warrants and sell their shares. They have a constituency they're representing. The process when it's de-SPACed, now you're really looking at a more conventional shareholder base for a company that's recently public, a big company that's recently public. So you have a base maybe of some retail investors, but legitimately most of them are long-term institutional holders. You have some parties who are short-term holders, and they say they'll have the same time horizon as they may for any stock, but it's a more conventional holding that as a public company, whereas there's a universe of SPAC hedge fund investors who participate in a lot of deals and look at a lot of these deals and make a bet. They make a bet, hey, I guess this group is going to be able to get a company. I think it's going to be interesting. I'm going to be able to ride the stock right on the announcement. It got so euphoric for a while, Andrew, that it's tempered a little bit, but not totally. Where companies in this feels a little bit like 1.0, the .com that you were
1999
on the pricing of a SPAC. No deals announced yet, nothing. They're just the company just raised money, the stock goes up. I mean, reality, there's nothing's happened, but they're just saying,
maybe it's true math. It's a past track record of like his last one's bumped.
Yeah, we know it's going to be great. I understand. I totally get why somebody would buy a deal once the deal's announced, right? Because they'd say, hey, that's a pretty cool company. I didn't think we could get our hands on that. That's great. And with this group, the sponsor group, and then with this management team together, it's going to be great. That I get, but when the stock is popping just on the announcement, which was happening, it happens still. Yeah, that reminds me a little bit of back 20 years ago when a venture capitalist would be in a deal and it would go up just because you saw the venture capitalist name in the IPO prospectus. You say, oh, it's just.
Well, I mean, if you made a 5x on my first fund and a 10x cash on cash in my second fund, people are, going to go into a blind pool of fund 3 and 100%. Say, his last fund was 10x and it only does as well as 5x his first fund, then I'm going to follow my way into that. What kind of bumps are we seeing? So $10 a share makes the math really easy. So a lot with, with these 200, 300 SPACs we're seeing in general, what is the scoreboard saying on $10 being up or down on most of these?
It's interesting. I was looking at that for something else I did. I'm just glancing at it right now. For the most part, I mean, this is a reasonably primitive analysis. I was just looking at deals that were basically taken public, but announced and closed, right? So there's, we didn't get into this. This is a little bit of arcane, but once you announce the deal, there in the U.S. you have the SEC, and you may have Euronext in Europe or something, where you're going through a whole regulatory process. There's a period of time. So between the announcement of the deal, getting the pipe investor, and then literally closing, and the de-SPACing process is going on during that. But I just looked at the IPO price of $10, the deals that were closed and completed in 2021, and TMT deals. And this is a week old or something. They were up like 45% plus.
Yeah, that's crazy.
I mean, and look, I mean, there's some interesting companies. I mean, there's definitely there was a company that was recently announced called IronSource, Israeli company. Right, they do app, they provide analytics for for gaming developers and app developments and so on. I think their last round, and again, this is hearsay, I'm not involved with the company, but I think it was reported in the press that the last round, 2019, was a $1 billion round or something like that. It was a unicorn. It was cool, very cool technology. They merged with a SPAC, which you will see a lot of now, that was backed by Thoma Bravo, right? The valuation on the deal is $11 billion. It's $11 billion on the
great for the VC, and then in the after performance went from $10 to
it's gone. And, they're going. I think it just started. It started trading, but I think I saw. I'm not sure if they're through the regulatory process. So I should hesitate. But I mean, the valuation was $11 billion. And, as a frame of reference there, because, I know we spoke a little bit about valuation. I think they were like 600 million of revenue or something like that. So, I mean, pretty cool company though, so, I mean, you're seeing that kind of stuff, and you're seeing certainly the pops. There was a company called Open Lending that was done like last year in 2020. It's definitely up like 4x. But they were, that's the interesting way to play the SPAC market. Get your hands on an interesting asset that the market doesn't have an opportunity to work with, and you can kind of create your own story and message around it. And then you're giving the public something that they ordinarily can't get. It's a scarcity thing.
I mean, I think, the number of publicly traded companies 10 years ago was twice what you have today. And there's 10x more hedge fund money looking to play into half as many companies. I think that, I personally think we're ready for the four horsemen to come back in some different, incarnation, and, start just IPOing companies without the whole SPAC thing, which seems still a little.
I mean, this is a little bit of a historical perspective, but I'm always intrigued by the quote unquote laws of supply and demand. And in reality, what's happened in the United States is that the number of, I don't know exactly the statistic, but it is enormous. The number of publicly traded companies in the US has curtailed so much that there's literally a really limited supply. There's a lot of good reasons for it. The advent of, capital rounds, larger VCs, private equity firms. There's a lot, and Sarbanes-Oxley, and I don't want to get into politics. There were a lot of reasons why it became very expensive to be public, and so many other alternatives that are so much easier to do. And I think when I observed this sort of phenomenon a few times, and when there's a shortage of a supply, people will create supply, and the SPAC is a way of creating a supply of public companies without the traditional risks of an IPO.
I personally think since the crash, the dot-com crash with Sarbanes-Oxley, and then stay private forever, and then the cost of an IPO, the cost of ongoing compliance, that people said, look, I'll just be privately held like Uber. Facebook wouldn't have gone public if it weren't that, like, there was so much secondary trading. They were violating securities law. IPO is the only way to be compliant, actually, because the public wanted it. So I think the SPACs are evidence that, public markets, whether it's institutional or retail, wants to participate in this value creation that's happening before the system was allowing it to go public.
Exactly. So I think, look, there's a legitimate reason. I mean, you were alluding to before, talking a little bit about the IPO process. The IPO process is expensive, it's time consuming, and at the end of the day, you're really at the quote unquote whim of the market sentiment at the time you go public. It's a long process. I mean, you have to file the document, you can do it quietly and everything else, but at the end of the day, it's going to be available in public. You can be a lot more quiet in the SPAC market. You can actually have involved conversations. You can achieve other means. You can have an earnout structure, right? You're still going to get the currency that you can use to attract other employees. You can use it. You can use it to buy other companies because you have a currency. So you still have a lot of these benefits. You just don't have this enormous and not knowing this enormous risk. You just don't know if the deal's going to happen. I mean, eventually, yeah, the deal might happen, but it puts a stain on a company that they go around and talk to everybody, and then markets are down. You have some sort of, I've seen this. It happens a lot.
I think it's nice to get Goldman Sachs, JP Morgan, and Morgan Stanley out of the room. They were being such annoying gatekeepers of, this should be public. And they're like, eh. And then the structuring of all the secondaries of like, I'll invest in Uber at 70 billion valuation, but I get 4x my money back, and after I get 4x, I'll pay you 60% and me 40. Once you're caught up to this, I get 90, you get 10. That is all so confusing that the idea that it was valued at 70 billion was just so Benchmark could raise their next fund, saying this is what the thing is worth, and this is the fair market value validated by this transaction. But I want to bring it back, Adam, a bit to what does this mean for startups? Like, so how big, what kind of revenue does it, let's just say you're the hottest SaaS company that should be getting a crazy mental, multiple on its revenue in normal times, but within whatever the market is. What, I have my own portfolio companies asking me, Andrew, how big do I need to be de-SPAC'd here? Like, is the SPAC route open to me, or can they get acquired into, like, there's like 6 companies in esports. If they all merge together, they're big enough to be, have enterprise value that fits with the IPO investment, or adding in some pipe investors.
Yeah, that's a good question. So I think that the best way to look at the SPAC market is you could, in theory, consolidate 6 companies at the same time. I have to tell you, 100 years ago, I worked on an IPO, and this was another phenomenon, which was, when in the later stages of the IPO market, like in the 90s, they were looking for companies to take public. So this concept of roll-ups occurred. And actually, company I worked with, it was actually the first company Jack Dorsey ever worked with. He actually left school to go work there, and it was a roll-up of like 50 companies, but they were all in the same software system and so on. But at the end of the day, that's not an ideal structure, to do a deal to everybody become public all at once, even if you're on the same system. So whether you're merging and these companies had a similar, they had a similar psychology and approach to the business. It was almost like a franchise model, so to speak. But the point is, if you take 6 companies and you merge them together to go public in a SPAC, so you can get the 80%, you have the dynamics of merging 6 companies, culture, systems,
most M&A
information.
Value, right?
So I've been referring to DraftKings as an example because they were interesting. They merged with another company simultaneously in the IPO, and you're seeing other companies. There's rumors about Axios and Athletic doing that. So I mean, you can, 2 companies you could see, and it could be an interesting vehicle. I think when you start to get past that, term breeds a crowd. To be under the public scrutiny, which is what you're going to be, I think it's a little risky. I mean, what could happen to me, the better move would be put 2 companies together if that's what you want to do. Do it in the SPAC format. Go out and buy the 3rd company after you're done with the SPAC process. Don't do it all silent, because to go through the public markets and everything else. I mean, you'll see companies do it, and I'm not as familiar with as many of them. I'm sure it could be done. I just think from somebody who's an M&A professional in Gp Bullhound, we're always working with growing companies, whether as an investor or as an advisor on the banking side. I think that's a little bit of a tall order. I think that the SPAC market, for a startup, look, there are startups that do it because it's such a story that in some respects that's a good way to do it. But I mean, I also think that there's a pretty high level of scrutiny. I mean, some of these electric vehicles, EV type companies, they were almost, I wouldn't call them startups, but they may have not had revenue yet. You have a few things
Oh,
like
yeah.
that.
That's a
So
red flag,
the thing that makes that easy is that, you have a little bit of will, you're telling people, give me 2 years or 3 years before I start really or doing something. You have a little bit of, wiggle room.
Yeah, but I hate that. That's a pump and dump. We can get out of this deal before the world finds out if this Bunsen burner science experiment works or not.
Yeah.
It's a huge red flag publicly traded at that point.
Yeah, I agree. I mean,
swap that out for VCs that can stay in the deal and get it fixed.
I mean, I think if you start to see too many companies do that, I really do think you'll see. I think it'll be hard to get those deals through. I really do.
That's rush the public markets for venture financing, which we saw at the end of the 90s, and it crashed and burned. It's like we saw it again with the ICOs, company going public essentially on a crypto exchange with a white paper, and you can get out before we find out if this Bunsen burner science experiment worked. I think that, like, I've been surprised to see Kendall Square kept doing it on biotech after the .com crash. Like, the window's shut for us, but they just, what is it, philanthropy, that if we can cure Alzheimer's, let's get behind this thing. But and as far as what's the criteria for revenue wise for a good tech company to go the SPAC route? Like, I think you mentioned 600 million for the Israeli company, which had a huge pop, but what's the general minimum revenue a company should have to consider this?
Yeah, it's harder to get locked into that. What I would say is, here's the way I would view it. I would say that when you start getting under, $500 million of EV enterprise value, and you can work backwards if you apply 3 or 5 to that, it starts to get, you start to run into what I would say liquidity issues. I mean, there are deals that are done smaller, but you're seeing a lot of the deals you're seeing, the most visible deals you're seeing are at least $750 million EV, which means that, it could be 250 capital raised. And if you want to work backwards, if you say 750, apply, pick your industry. You want to pick a SaaS business, and apply a multiple of ARR to that. You're going to get to, you work backwards. It's a very unique company. You want to get into, 15 times AR, something like that. Sure, it's, I mean, I think those things are out there. I'm not sure where the metric is right now, but I mean, you can work backwards to do that. And the same way, if you want to use EBITDA as a metric. Some of the companies that are more story oriented, you would see, future EBITDA, future revenue multiple. That's
forward looking.
Those deals are getting done. Those deals are getting done because people see them as unique.
And so, of the ones that are listed, the aftermarket performance, what kind definitely on sales, or ARR, or multiple of EBITDA are we seeing? What do you think?
It's you're definitely seeing some very, very high numbers. You're definitely seeing, yeah, you're definitely seeing some very, very high multiples out there, and you're seeing them sometimes off of 2023, 2022 for sure, in terms of multiple valuation. I think yeah, I mean, it really depends on the business. As I said, if you work backwards to, you looked at, Iron Source, I don't know, I think it was like, again, it's a private company, but I think it was like 600 million in revenue or something like that. Just moving, I mean, I think, and it was, and then, you're looking at $11 billion of enterprise value. So
yeah, and liquid, which is amazing. I mean, in theory, with in the currency and all the good things that come with that. What's very interesting, Adam, to me about this is, if you're the CEO of a privately held, say, VC-backed company, or you're the VC on the board, and you're thinking in a post Sarbanes-Oxley, what do we have to pay for an IPO? How long is it going to take? And what's the ongoing compliance cost? And these numbers start looking like $6 million. Like, do I really want to do that now? And do I want the distraction of dropping the ball on sales? We're booming sales. We're benefiting from COVID. How long is this going to take? If someone just shows up and says, boom, it's on the table, like here's right on the table, the decision is just yes or no. Like that's actually a fascinating thing to go from, do I have to go through all of this stuff at a minimum of 4-month roadshow and being away from home constantly in theory, and compared to sponsor managed to push this thing this far, and here's their offer on the table. That's kind of fascinating.
Yeah, yeah. No, look, it's an interesting phenomenon for sure.
Well, Adam, listen, thanks so much for all your insight and explaining all this. I want to close in just what is changing, if you can say, like with the different actors, from sponsors to the IPO investors,
Sure.
to what do you see as changing in these different phases and elements? And are we maybe with supply and demand getting a little too spicy? I mean, in the first quarter of this year, we seem to have eclipsed all of last year.
There's no doubt that there's a lot of activity. I think you're seeing a few dynamics for sure. You're seeing private equity firms. You're seeing specialists in certain industries, Cushman Wakefield, Union Square Hospitality on the restaurant side, right? You're seeing companies that are seeing SPACs as a vehicle for them to get something accomplished. On the private equity side, Orlando Bravos is raising a massive fund. You have elements of KKR. You have you name the private equity firm. They probably are thinking in some respects. Sagemont, just recently filed something. I have like the name. I have the names here. Guggenheim Capital was Lazard on the banking side. TPG, Truwin. There, Bain, Ares, Apollo, Carlyle. You have all these companies out there. Then you have, as I mentioned, Social Capital and others who are, DMY, Cone, who's out there, who's doing everything in the fintech side. So what you're going to see is and what you're also seeing is, Daniel Ock, for example, has a SPAC, Ajax, that, what they're trying to do is differentiate themselves and align. You're seeing an alignment more of the sponsor with the investor in the deal. That's what you're seeing. So you're seeing, somebody volunteer and say, I'm not going to take 20%. I'll take 10%. I won't take the 20%. I'll only take a portion of that, and I'll take another portion of that once the stock is up in price, so that everybody's interests are aligned.
Yeah.
So that's where I think you're seeing a delineation of where the markets are going to move, and people's success in the past, they're gonna put their money where their mouth is and say, I'm still gonna make money. I don't need to make it up front. It'll be easier for the target company to accept our terms because they see how we're aligned.
I think if you see like a KKR, Carlyle Group, Bain, not on the VC but on the PE side, they want to do it repeatedly. They don't want to do a one-off and it fails. So they want to make sure that you had that bump. $10 goes to $100 or at least 40, so they can do it repeatedly. Also, these are change of control people. Like as a venture capitalist and even at Gp Bullhound, you guys aren't taking a change of control. We're both coming in and buying a minority share in the company and let the management run and support them as much as we can. Where KKR, one of my LPs is from KKR, and he bought Boots and then he merged it with Walgreens and then made a killing. And it sounds like a lot less work than some VCs are doing, and he's doing so well, he's investing in our funds. But they're change of control guys. So if you're saying I did that with just Boots and Walgreens, look what I could do in this sector, and we know the drugstore sector or whatever, and so it kind of makes sense that they would be the ones that get back repeatedly. And if
it's an alternative way of looking at doing a buyout. That's what it is, right? I mean, a SPAC is it's a different, it doesn't have the same dynamics as the PE, a fund, right? It's not 10 years and everything else. It's just a different vehicle. It's a way to, it's almost like a different product for them.
Yeah. Well, I'll close by saying I think there's a pent up demand for IPOs, period. And the system has been pretty broken since 2001. And this is like evidence that cork wants to come out of the champagne bottle. And we should probably start IPOing companies in a bit more straight up regular manner. And this just provides more exit opportunity for startups and venture and VCs that are in them. So I think the SPAC sounded a little funny in the beginning. Sounds like it's a reverse shell merger kind of thing, or search fund, but I think it's a good thing. So I think they're here to stay. I hope. And why don't we close out there? So Adam, thank you so much. I look forward to seeing you in person at these GP events.
I enjoyed it, Andrew. It was a pleasure to talk to you, and I enjoy all the stuff that you do. So it's great. Keep doing it.
Okay, buddy. Thanks so much. See you soon.
Thanks
Bye
a lot.
for now.
Bye now.